So the first rates, brand new week, an important week, a brand new month, an important month, and it's good to see a rub of green, and it's good to see a rub of powerful green on ICICI Bank. 20 rupees higher for ICICI Bank. Reliance numbers came after the bell on Friday, late Friday actually, and Reliance numbers are not really injecting some degree of momentum, at least in the stock, and the stock has reversed completely. 40 rupees down for Reliance. The consumer business is growing, but the petrochemical business continues and the refining business continues to remain under pressure. Let's look at the auto dispatch numbers. Hero MotoCorp came out with auto dispatch numbers. Maruti has come out with auto dispatch numbers. Last week we also heard from the management of both of these companies, which were sounded quite, they were quite confident of the near-term recovery and the recovery sustaining even after the festival demand. So Hero MotoCorp has bounced back. Maruti has given you a good bounce after the numbers, but the star today, hands down, is ICICI Bank. Is ICICI Bank and IndusInd Bank also, which came out with numbers where brokerages have upgraded their price target. So are banks making a comeback? Is this entire is this entire rub-off effect now visible even on State Bank of India, which is due to declare numbers later this week? Let's look at it. Are corporate banks making a comeback? There's nothing wrong with the numbers which have come so far from Axis, IndusInd, ICICI, and now HDFC Bank. Just look at SBI once again, please, just to establish a point here. That's HDFC Limited, HDFC Bank, and State Bank of India is what would be an important number for rest of the day, because it's a stock which again has underperformed, and it has underperformed immensely. Okay, something wrong with the graphics. SBI is what I wanted to say. Aisha?
You know, Reliance, that's the key culprit today. Just bring up the intraday graph, and it's a gap down start for Reliance Industries, even though the numbers were actually impressive. 2013 is where Reliance is, and my sense is that this should be a fresh low in the last few months, because Reliance, if you recall, for the last many months has managed to cling on to that 2000 mark. But a level of 2013 and downtick of 2.5%, that's exactly what's playing out in the index. I mean, at a time when you've got autos and ICICI Bank actually holding up, the Nifty is unable to push it forward because it's a bit of a tug of war between ICICI Bank as well as autos. In fact, most other banks which are actually holding up in the green, and Reliance on one end, which is acting as a very, very big drag. And Kunal, now we're down 3% in Reliance Industries. To my mind, that's the biggest, factor which is dragging the index lower, and we're still lying flat.
What I was indicating earlier as well, that the stock has shown signs of weakness. There is a clear reversal of at least the short-term trends. Many of the indicators which we generally give more weightage to when we analyze the stocks, those indicators or the behavior of those indicators have changed. And that generally leads to, I would say, a very drag kind of a reaction to the stock prices. So I think it doesn't come as a surprise that, Reliance post results is trading lower. I was indicating, I think last week as well, when we had a discussion that the stock could probably come back to a 1900, 1950 kind of a zone. I think that should be a credible, range for short-term supports for Reliance Industries. But the fact that the stock has even broken this 2000 mark, I think indicates that there is a clear short-term weakness which is lined up ahead for the stock.
All right, it gives me great pleasure to bring on board Abhinav Khanna, head of Citi India, to talk about what the Citi India outlook is and where they feel India is headed, and which are the sectors which, in a sense, post this earnings season are likely to outperform and underperform. Abhinav, fantastic to have you back on ET Now. Thank you for joining us. The non-believers, Abhinav, are saying that it is only liquidity and cost cutting which is taking markets higher. It's a rising tide which is unlikely to sustain. So what is your sense? Do you think the kind of recovery data, what we've seen on the rural front, on the corporate front, from auto companies, from consumer durable companies, is only hope and hype?
So you're absolutely right. I think the rally in the markets from the lows of March has taken everyone by surprise. And let me break it into two parts. So the first part being what has caused the market rally, and where has the street been surprised? And then the second part would be, would this sustain or not? So to answer the first part, I would say that the market rally began with the liquidity thrust. After the markets bottomed in March, we saw commentary from the central banks globally, as well as the various governments, which was related to fiscal stimulus as well as the monetary stimulus. And that is what gave confidence to the investors that it could be a very liquidity driven rally that can happen from the lows that I just referred to, which you saw in March. And that was when the markets, like the Nifty, rallied from sub 8,000 levels to nearly the February levels in this 5 or 6 month period. Interestingly, the S&P 500 also has recovered all of its losses, and it's actually up around 1.5% year to date. So the rally initially started with belief that there will be a huge flush of liquidity. But then more than this, what has taken the investors by surprise is that the companies have delivered earnings which were better than the worst expectations. So if I just look at the earnings in India, in the June quarter, right after the worst of the pandemic happened, you actually saw that the companies surprised us on the cost front, while they were still struggling on revenues. But to their credit, as I said, they did well on the cost front. What they have continued after June is that they have not only maintained their cost discipline, but have been able to get much better sequential revenue growth as well. Hence, the results that we have seen for the September quarter till now have actually been a combination of a bit of revenue beat and also a continuation of the margins beat. And hence, we have a scenario where, as of today, roughly 40% of the Nifty companies have reported numbers, and the earnings for those 40% of the Nifty companies are up 10% year on year. The EBITDA is actually up 20% year on year. And this is actually well ahead of what Street had expected for these set of companies. So I would say that at least on the earnings front till now, things have been quite good.